The big Fed meeting is coming up with an announcement at 2 p.m. Eastern Time on Wednesday, the 14th of December. What's interesting about this meeting is that the implications for trading are far more focused this time on the member projections, the dot plot, the statement, and the press conference rather than the actual decision. The decision, most people are pretty much 100% expecting the Fed to raise interest rates here in December. They have not raised interest rates all year yet. The U.S. is close to full employment. The U.S. economy is doing very well, and inflation is on the rise. The Fed has held off on raising rates earlier this year due to things, uncertainty around Brexit, uncertainty around the U.S. election. Now that these things have passed and the economy is moving on, many members of the Fed have indicated that it's time to raise rates once again. The last time the Fed raised rates was in December of 2015. Prior to that, the U.S. dollar had rallied, but in the weeks just before the Fed rate hike, the U.S. dollar peaked and actually started to come off as people started to look past the initial hike and into what the monetary policy situation would look like for the coming year. Once again, once the street is more likely to look past this rate hike that's likely this week and into how many rate hikes might we actually expect to see in 2017. One of the reasons that the U.S. dollar took off so much in following the election was people felt that Donald Trump would bring in fiscal stimulus, that it could be inflationary, and it could force the Fed to accelerate the pace of rate hikes. As it is, when the U.S. dollar before the election was trading about 95, that was pricing in about two rate hikes for the coming year, perhaps say one in June and one in December. Rallying up to 102 where it is, at 100 you're pricing in about four rate hikes. At 102 you're pricing in 5 rate hikes. If we include this month, December 2016 as one of them, then you're looking at 1 hike now, and the street for the US dollar is pricing in 4 rate hikes next year, likely March, June, September, and December. However, if the Fed comes in less aggressive than that and says, well, perhaps we're looking more at 2 rate hikes, then the US dollar could tumble, and that could have a very significant impact on trading across a number of markets. And the reason is we look at the US dollar here, that it's had a massive rally following the election, but it has been topping out here in this 101 to 102 range, running into quite a bit of resistance. It's become overbought. This has eased back to neutral, but still there could be room for a more significant correction. Some support levels to watch in and around here. This is about 130. This is the big 100 round number, and in around here, between about 99 and 99.25, you have the 50-day moving average and a Fibonacci cluster. So this is an area you could potentially see tested in a more significant correction if the Fed comes in less hawkish than the street is currently anticipating. What could a U.S. dollar correction mean for other markets? It could lift the lid off a number of markets that have been under pressure of late. Let's take a look at gold, especially as it trades in the opposite direction of the U.S. dollar. As the U.S. dollar spiked after the election, gold has absolutely crashed. You had this big shooting star here. Gold has just been trending down, 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 down. But look at this. It's extremely oversold. Small positive divergence. Downward momentum does appear to be fading. Support is coming in here around 1150, 1152. We've got a hammer candle here, which suggests a potential base. But today, so far, we haven't seen the ignition to the upside. We're probably going to have to wait on direction when we actually get the Fed meeting. Another example here is the dollar yen. Looking at it the other way, this is, of course, with this screaming higher is the U.S. dollar strengthening, the Japanese yen weakening. We've seen it just soaring here. And this, if this turned red and started to turn down, would be an evening star candle pattern. We've had a huge rally, but again, upward momentum starting to moderate. Negative divergence in the RSI hugely overbought RSI. Signals that upward momentum slowing, and this is vulnerable to a correction. Trading here, this is the resistance about 116.20. This is right now it's trading between 115 and 115.35. First support and a correction around 114, and then perhaps down closer to 113. The dollar and the Bank of Japan has their own meeting next week, so this one could be waiting for that. But overall, the gold and the yen have become particularly depressed of late. Just to highlight a few more markets here that could move. The British pound, talking back about Brexit, had tumbled dramatically, followed Brexit, and tumbled again here in the fall ahead of the election. But look at this in recent months. Huge ascending triangle base forming here below 128. We're back trading, sitting on this 127 for support Fibonacci level here. We've got solid trend of higher highs in the price. as well as a solid trend of higher highs in the RSI. We're above 50, and more importantly, we're not overbought. So this has technical room to run, and it's under really nice accumulation here. We'll also take a look at the euro dollar, which looked like it was starting to turn up out of a nice saucer bottom here. Had a setback with the ECB's non-taper, where they did a one and done cut to their QE program rather than a series of cuts. However, since we've now got a double bottom, a triple bottom almost in place here around the 105 level, it is starting to come back. Support has moved up to 106. First resistance, this is 106.85, and up in here is 107.80. And the RSI is showing we had not a breakout yet, but downward pressure definitely easing after it got extremely oversold. The one other currency I wanted to highlight here is the Canadian dollar, another one that could rally. The Canadian dollar has been getting held back relative to the crude oil price. We can see since the OPEC meeting, the crude oil price has been screaming higher. Canadian dollar has picked up, but nowhere near to the same extent as the crude oil price rally. So there's lots of room for it to catch up, but it has been lagging, the loonie that is, because of the strength of the U.S. dollar of late. If the U.S. dollar starts to do a correction, this could ignite a catch-up rally for the Canadian dollar as well. So we USA, right now, the street seems to be pricing in 4 to 5 rate hikes over the next year. I suspect it's going to be more like 2. It's the last year of Janet Yellen's term. It's unlikely she's going to be renewed. She's likely going to be replaced in January of 2018. I don't think she's going to be in that much of a hurry to go totally aggressive on raising rates. I think the Fed will still focus on a more gradual thing, especially because this inflationary impact of Trump policies that people have talked about, more likely to not hit until 2018. So if the Fed wants to, the only way you would see a more aggressive Fed is if they want to get ahead of that. If they're prepared to let the economy run, then you likely see a more moderate upward path for interest rates, more likely 2 hikes this year to take them back up to the neutral interest rate, which to me is around 1.25%, give or take. So the important thing is that the Fed meeting, likely to be very important for trading, could kick off a number of significant moves in currency markets.